It's Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives. At the start of the year, Rick Pitcairn took on a new position as the chief global strategist at Pitcairn, a 100-year-old multifamily office with $7 billion in client assets. And in that position, he is focusing on macroeconomic trends and is searching for new global initiatives that will add to the firm's growth. Rick recently went to India, where he met with some of the wealthiest local families to discuss multi-generational wealth transfer. And he saw that people all around the world want the same things, including economic security and a safe environment to raise their children. But the investing and business environments differ significantly. Rick knows that U.S. investors have a home bias, but he saw substantial economic growth is happening outside our borders. And Rick is here to discuss if an international allocation is appropriate or too risky. Tell me a little bit more about yourself, your career path, and also about the history of Pitcairn.
I've always been an equity guy. I actually started as a CIO for a long equity growth at a reasonable price money management shop. And after a period of time, they recruited me to come to my family business about 20 years ago. And I proceeded to take the reins as chief investment officer there and build global portfolios for these complex multi-generational families that we serve. Pitcairn's proud to be a 100-year-old multifamily office. We're celebrating our 100th year this year. In that capacity, we really help multi-gen families in all aspects of their wealth. And obviously, investing is a bedrock of some of that help that we do. So my career has really been built around building portfolios that actually stand the test of the long run for these families. I'm blessed to have a set of families as clients, by and large, take a very long-term perspective towards the capital markets. And I've worked with them over the years to try to understand that even if you're, a family that's based in Tulsa, Oklahoma, and 100% of your business is U.S. based and 100% of your liabilities is U.S. based, that a global portfolio really makes sense in light of the changes we'll see for the next 20 years. So it's a lot of what I've worked with.
Well, we're going to talk about global opportunities. I want to talk about your trip to India. What ways or what differences did you observe between the investing and the business environments during that trip as compared to what you see, for example, in the United States?
I've been to India before, and this particular trip was another fascinating one. I helped found a group that we founded at Pitcairn called the Wigmore Association, where we were 8 chief investment officers from multifamily offices around the world, and we traveled to many countries to learn about their investment climates. And India is a unique one. You can't from the minute you land, you can't. You're really sort of astounded by the differences. And India is not perfect by any means. It has striking poverty. It has environmental trouble. It has all these things that are going on that are impediments. At the same time, as you get into the business community and you talk to these families and talk to the people who are driving inside that country, there's this tremendous sense of optimism for the country in spite of all the impediments they face. And, it seems like sometimes in this country, the impediments we face are less, but it gives us this great sense of pessimism about the future of our country. And I think it was the exact opposite in India, where their impediments were great, but their optimism around what they could do and what the future held was unbridled. And as an equity guy, equity guys are optimists, fixed income guys are pessimists. I like that optimism and I like that market.
Well, I'm going to talk to you as an optimist then. How can U.S. investors incorporate the robust growth that you saw that is happening in India and other places outside our borders into their client portfolios?
Look, one of the things that I've preached always is that, particularly for the families with the long-term view that I have, that, the growth in your portfolio should come from a long-term strategic holding in equities. I think that there's many people who can trade their way to wealth, but I think for the families we serve, to think about strategic allocations to asset class and using the Ibbotson chart and long-term returns to asset classes as a tailwind is as a far higher probability of success. So, we believe in equities as a growth core of the portfolio. Now, those equities can be public, they can be private, they can be indexed, they can be active, they can be U.S., they can be non-U.S. But I think all investors should have broad exposure to these asset classes. They can certainly expand and contract those exposures as market conditions dictate those changes. But rather than trying to rotate in and out and go 100% in this and 0% in that, I think that there's a siren song of massive success in that is very difficult on a probability weighted basis to achieve. So we believe in understanding what it is that you want, getting some good advisors around you, and incorporating long-term global equities into your portfolio.
Now, you're investing for wealthy families that are looking out over many generations. They necessarily have a long time horizon, but how long does that time horizon have that large allocation to equities? If you need the money, say in 5 or 10 years, is that a long enough time horizon?
10, maybe. I think 5. I think, I'm not sure exactly how long an investment cycle is. I just know that it's longer than investor patience. And if you dig in to the academic research on the topic, which I've done pretty extensively, it's a long, market cycles are long, 5, 7, 10 years, or something like that, not 2 or 3. So you do need a good long time. And it, as I said earlier, I find it really gratifying as I guess I've got, when they change your title and you've got some gray hair, you begin to look at your career in bigger chunks. And, I've really had the good fortune to be involved with families that look at me and say, Rick, I want to build this portfolio for the next 50 years. I want to build this portfolio for the next 100 years. Help me construct it in that fashion. And I think that's actually a benefit because you can see through some of the vicissitudes that the rapid trading environment brings into markets. So, it needs to be a long time.
Tell me about what you saw during your trip to India when you observed the wealthy families there, about how they are successfully implementing multi-generational wealth transfer.
I really do. I had a family say to me, they thought in matters of long-term investing, multi-gen wealth transfer, family office, India was 50 years behind the U.S., or 30 years behind the U.S. And they're really just, and I think it's one of the exciting things about India, and there's other countries around the world that reflect this as well. They're just getting to the point where these businesses are growing and creating wealth for these families, and they're actually looking at a situation which wasn't even tenable even a generation ago, where they could actually put a structure in place that could benefit their family for 3, 4, 5 generations. I mean, because of the political changes in India and because of some of the other dynamics involved in their economy, that wasn't something I think people even think it as a reality as recently as 10 years ago. And now they're trying to look outside of the borders of India to see how other families have done it globally. They're constrained because India, like several countries, doesn't want those rupees to leave the country and doesn't want that wealth to leave the country. So they have a lot of constraints on how they deploy their assets and how they deploy their currency that we're not bound by so much here in the U.S. and certainly you're not bound by as a global investor. But they're sponges for learning, and I saw several families who, it's interesting. When I deal with families here in the United States, the story more typically, at least the families that we've dealt with, is my grandfather started this business. We worked very hard over the period of 10, 20, 30 years. We just decided to sell to a conglomerate or sell part of it to a conglomerate. Now we have this liquidity event. Come help me. This wealth has been created so much more quicker, Bob. I mean, it's just, in 2016, we struck a deal with this U.S. bank. We did their back processing. And then last year we sold it private equity for $180 million. And they just built it that quickly. And now it's sort of, what do we do? I want my kids to learn. And so it's a much more immediate set of questions than the stability that the U.S. environment has brought tends to saddle us with.
Based on the growth in both the population and the economy that everyone sees in India. What's your prediction for its role as a global player?
At least under one calculation, the Indian population had surpassed that of the Chinese population, but they're very close. India soon will be the world's most populous country. And again, as I was alluding to earlier, I think we take political stability in the U.S. a little bit for granted. I mean, by and large, there's changes in our Republicans and Democrats and right and left and so forth and so on. But our basic form of government is relatively stable for generations. That changes pretty quickly in other countries, and we don't quite appreciate that here so much. So that makes these things hard to predict. You have a country where, they're beginning to see the ability to move the middle class up the consumption and quality of life standard rather quickly. I think they like that. So they're trying to build in structures that support it. And the more China, the real wild card, of course, is China. And, China itself is quite dynamic. When I first went to China in 2013, all they wanted to do was partner with U.S. companies. And all they wanted to do was bring U.S. capital in and figure out ways to partner. I went again in 2017. That had cooled dramatically. And now it's even worse than it was in 2017. So to the extent China pulls back from the world stage or pulls themselves away and separate from capitalism, I think that gives an opportunity for India to step forward in a way that could make it quite dominant.
Let's pause for a couple of minutes for a word from our sponsor. I know that you already enjoy our content from Advisor Perspectives every day. So why not use our award-winning articles, commentaries, and charts to streamline your communications with clients and prospects? My team and I introduced AP Premium last summer, and we've been blown away by the response from the advisor community. Keep listening for an exclusive code to get $10 off our premium service. You won't find the in-depth, sophisticated market analysis and charts like Advisor Perspectives anywhere else. This information can be invaluable to help your clients understand complex topics. Let's say a client asks a question about their estate plan. Instead of spending time researching and drafting a long-winded response, quickly grab any number of related articles from our library and share it in a personalized way. AP Premium gives you the power to add your logo and a personalized message to any piece of content and share it directly with your clients and prospects. We also introduced a premium offering called the Ask an Expert webinar series. At our inaugural session, we were joined by Wade Pfau for an intimate Q&A. Advisors have told me this is one of their favorite perks of being a premium member, and we can't wait to share who's slated to join us next. Give Premium a try and see for yourself why it pays to be a premium member. As always, we appreciate your support of our efforts to bring excellence to financial journalism. And as a thank you, I'm offering a one-time $10 discount for new premium members to be taken off your first monthly or annual payment. Just go to advisorperspectives.com/member. That's advisorperspectives.com/member and use the code podcast 2022. That's podcast 2022, all caps, at checkout. And now back to our podcast. You're a manager of managers. You're an asset allocator. Do you have a sense for the non-U.S. markets that you and your managers who you're using are analyzing or looking at as potential investment opportunities? And what is the rationale for doing that, given that the U.S. economy is heading into a potential recession and faces its usual level of political and economic turmoil?
I'll tell you a story. Many years ago, I saw you present at a conference that you were at, and at that same conference, Rich Bernstein, who was formerly at Merrill and has his own shop now, gave a presentation. And one of the things Rich said in that speech that I think continues to be true today is he always says, everybody thinks that for the next 10 years, whatever worked well for the last 10 years will work well for the next 10 years. So give me some NVIDIA because it went crazy for the last 10 years and I want NVIDIA for the next 10 years. And he said, it just never works out that way. It's always something else for the next 10 years. And certainly I've had many a client come to me over the past, particularly 6, 7, 8 years saying, why do I want to invest outside the US at all? We've had this incredible run. I just want all US. A lot of that, as you know, is keyed to currency, and we've had an incredibly strong dollar across this period of time. We found ourselves in an incredible moment of history where there is a trend towards de-dollarization. We're going to have a debt ceiling negotiation this summer, but debt is somewhere around 31 trillion, and that's a meaningful number by any measure. And there's questions about the viability of the dollar going forward. I don't think that means dollar collapse. I don't think that means something like the Chinese yuan becomes the Chinese currency becomes the dominant world currency. But I think it's fair to say that the dollar could reduce itself in value of 20 or 30% over the next 5, 10 years, just like it increased in value over the last 10. If that's the case, non-U.S. equities will do quite well as a class. You have to go in and understand which one of those markets will be favorable and more favorable than others. We're a fan of active management in that area because of that fact. The U.S. has some challenges ahead. We've got our first inflation fight on our hands since the 70s, and we've got some geopolitics coming in that poses interesting questions. And I think that investors who think they're going to get the kind of 16% annualized U.S. return that they got in the last 10 years, I don't think they're going to get that in the U.S. They may not be able to get that anywhere. It's reasonable to look forward and see that non-dollar denominated foreign markets could have a nice period of time vis-a-vis U.S. markets.
The outperformance of U.S. has been going on for a long time, and I think that reversal is long overdue. And thank you for those kind words about that conference, the Tiburon conference.
I think it was a strategist conference in Los Angeles, maybe 2009, 10, something like that.
Okay. Well, Rich is certainly one of the most astute market observers that I've come across. I always look forward to reading what he writes, and I think you're better off doing the opposite of what happened in the last 10 years rather than trying to do the same thing. Talk about the approach that you use, again, as a manager of managers, to diversify portfolios to optimize your success.
We use a combination of active and passive in more strategic allocation than tactical. Well, there's a place for tactical, but we don't think it should dominate a portfolio. And I think that comes from our DNA of I don't think there's a lot of shops like ours, but certainly one of the hallmarks of our shop is we don't really run any institutional money. I mean, we just run family money. And as such, every client we have, taxation is just a major influencer of the end return that they receive. So, it's hard to be real tactical in the light of taxes because the rates are so high on wealthy families, and we try to couch that. So we've got these long-term postures that have really worked well over time.
To what extent do you believe macro factors, issues such as geopolitics, will drive market trends compared to the micro factors? And how can investors effectively mitigate risk when it comes to thinking about those types of issues?
Well, I've given a lot of thought to this, and I think we're in the midst of a sort of a secular change in that regard. And the way that I think about it is this: if you live in a world where political tensions are low, it's largely peaceful, trade is largely free and ubiquitous, the world that you could have said we lived in 2005, 2010, 2015, I think the micro factors come to prominence in that kind of a world because there's stability at the top, and then you can go find those avenues down in the micro factors. And so it gives rise to a Renaissance or a Stat Arb program that can really drill down and take advantage of levering these little bitty dislocations in valuations. We've been talking about a 70s style portfolio and a 70s style environment, and we talk about that for a couple of reasons. We think that there's a good chance that at some level this inflation fight will be with us for a while. We haven't really had an inflation fight since the 70s. It's amazing for me to sit here on May the 11th and look at you and think that there's been a World War II ground conflict in Europe for the last 15 months. I mean, I didn't think it'd last 5 weeks. And when you begin to have more geopolitical conflict, more war, higher levels of inflation, I think then the macro starts to take precedence over the micro, and you have to do sort of a macro screen before you can take advantage of the micro. And that's very much like it was in the 70s. And I think that's the environment we're sort of heading into. I think that I don't believe that we're going to have a massive World War III with China. I don't believe that globalization is dead at all, but I do think that we're going to enter a period of heightened tensions, and we're going to enter a period with a bit more inflation and pockets of inflation. And I think this is a time to really pay attention to macro analysis and macro factors. And I think in my new role, not being chief investment officer for the first time in 16 years, one of the things I'll be focusing on is global macro factors, and I look forward to that.
On the subject of global macro factors, let's talk about the dollar. You mentioned earlier that we've benefited from many years of a strong dollar, but we also have these geopolitical factors to consider, and the rise of China and the rise of India. What is your prediction for the strength of the dollar, its role as the reserve currency, and what is the impact that those predictions will have on the capital markets?
The dollar's overvalued, but I don't think that the period of, say, dollar, the dollar being the world's reserve currency is over. I don't believe, for example, that the Chinese currency will soon be the world's reserve currency, for the simple fact that it's not freely traded. It's hard for me to believe that, if you have a currency that if tomorrow we freely traded it, everybody would sell it. And it's hard for me to believe that's going to be the world's reserve currency. But if you open the Chinese currency up to the free trade of the markets tomorrow, Chinese would sell it in huge fashion. So I think the dollar, it has been for a number of reasons. It's had a great 10 years, as we discussed. But if you take a look at our fiscal situation, our growth as an aging economy, some of the factors in international trade, I think a 20 or 30% overvaluation is fair. And I think it feeds right into the thesis that we've been talking about today in terms of the attractiveness of, a basket of non-U.S. securities.
If there's one key takeaway that you would leave with our audience of financial advisors about the questions that they should ask before making an allocation to non-U.S. assets, what would that be?
I think I would make sure that my clients and my investment policy were moving into this asset class in a strategic way. I think it's a difficult class to trade, even with good active managers. As I alluded to earlier, coming in and out causes taxes, friction costs, and I think it's difficult to execute. So I would make sure that you're going into this asset class for the right reasons and measuring it in the right ways. I think a lot of people, when they see my work, they think I'm all about international investing. Well, I'm sure that our portfolios are overweighted U.S. to the MSCI. We just have a complete allocation to non-U.S. stocks, and we'll continue to do so. And that's what I'd recommend to those advisors who are looking at that for their clients.
Well, we will include some links in our notes that accompany this podcast where you can learn more about Rick, and the Pitcairn firm will have a link to Rick's bio and a link to the Pitcairn company website. Rick, is there anything else you'd like to add?
Thank you very much for your time today. I appreciate the interview.
Quite welcome, and thank you for your time. And thank you for listening to the Gaining Perspective podcast with Bob Hoopsher, today featuring Rick Pitcairn of Pitcairn. To support our podcast, please Share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.